we will cover several points from the foundation of the company, operational excellence, and how to exit, let's say, the country or exit your business. So first, in terms of foundation, one of the first points you need to take care of is the capital structure, because it seems more or less when you're in Europe, but in China it can have some impact. So we will go more deeply on it later. Also, which kind of framework you want to put in place, if it's a Wi-Fi, if it's a GBU. So Wi-Fi, for those who don't have it, I think here it's okay, but probably people who are online don't really know. It's already for an own enterprise, so company owned by foreign investment. So GBs, joint venture, and representative office structure. Also, which kind of financial architecture you want to put in place from the beginning, because it can have impact on your long-term activity. Operational excellence as a second step will go deeper on liquidity management, how to manage your cash, which kind of risk you can face off, the regulatory risk, through FAR period management. So most of you here, I think, probably know what FAR period is. It's vacant, no? Change your mind, no? And group integration strategy, because if you're part of a group with in Europe, you can face a lot of issues like transfer pricing, consolidations, and other issues in terms of financing. So I will cover all these points. And in terms of exit and strategic exit, which kind of liabilities you can have in terms of employees, suppliers, and also tax. And first, tax before the rest. Tax will be the first point you will have to take care of if you want to exit. Also, the capital repatriation and some legal risk mitigation to protect the company to coming back later. So another times and delay. So here we will, in our different points, we will see, let's say, the challenge between the complexity of the regulatory and financial accounting environment and opportunities. So in terms of regulatory, it's quite clear. The thing is, regulation change all the time, but it's very important for you to understand them. To be is not something you take on the side. It's very important point, because if you don't follow all the adjustments, it will be much more difficult for you to keep up with all the change. And at some point, you will face some issues.
So local nuance, FAR period versus invoice, as I mentioned. Also, we have some, let's say, governance gap, because for sure in Europe, company mostly want to use their GAAP, so the general accepted accounting principle, but our accounting principle is different here. And the thing is, most of the time to be better. Okay, good. So we have the CAS, so the Chinese accounting standards, but to be able to consolidate everything, more company from Europe use company GAAP or IFRS to make consolidation. So objective will be to bridge the governance gap and to protect the company. So I will give you some elements to mitigate your risk by being compliant here. Also to have transparent financial governance and so strategic partnership for sure, to be able to, if it's in terms of GB, for example. So the compliance here is not only a cost center. We see a lot of clients who's, okay, I do the financial, but for me it's a cost. Here it's it's not just a must to have. It's very important to have it because it can make put your activity at risk. Okay, so strategic foundation. So you remember my 3 points. Okay, it's coming. So we will see about the capital strategy, entity setup, and ERP structure for companies who are a little bit bigger. So for capital strategy, it's quite important to be sure about the amount of capital you will put in place or you will decide to inject, because under the China company law, the shareholders are liable of the capital contribution. So it's not always the case, depending on the country, but it's not always the case. And it can be an impact on you at the end, depending on which kind of structure you set up. But it's a framework you have, but it's important to have in mind. And at the time, if you are in a bankruptcy or you as a shareholder, you have a liability linked to the capital. So when you prepare your capital to enter the market, you have Chinese market, you have several points to have in mind. So one is the cash efficiency, because if not, you will be tired by funds. If you put too much cash inside by capital, too much cash inside the country. But if you are undercapitalizing the company, you can have some, let's say, scrutiny from authorities, because they will understand it's not enough for what you want to achieve. And also you will need to use the capital or the strategy to have the cash in the company after. So have a right plan. It's very important. So that's why your business plan, it will help you to mitigate the risk. You need to be sure, is not always sure, but you need to be the most accurate as possible about the fund you want to use based on the activity you are doing. So probably I will probably mention it after, but when you have a business license, you have some activities linked to this business scope is linked to this business license, and for sure the need of capital will be different based on which kind of activities you are doing. So in a simple way, when you have to define your capital, is better to know the level of operational burn rate you need for 24 months. So it's mainly what the demand for each, let's say, for the authorities to validate also the companies. That's one of the points they are checking. So aligning with a realistic business projection and consider all the kind of requirements, so business license, which kind of scope you have, and planning for future increase. So because each increase of capital will be a cost for the company anyway. So balancing, when you prepare your strategy in terms of capital, you have to balance between your risk and your efficiency. So you need to be prepared to do what is the most efficient for you based on the regulation. Establishing your presence in China. Here I put some timeline. I probably it's a little bit small for some, but because we will share it after, so I try to have the most more elements on the presentation. So in terms of setting up a new company, you will have several phases. So first, a pre-approval and then registration with around 1-2 weeks, depend of where, which kind of district, which kind of cities, etc., etc. But 1-2 weeks is mostly the average. Incorporation, 2 to 4 weeks. So you first validate the name, and after we do the process of incorporate the company. So feasibility study, lease agreement, and issuance of the business license. So now everything is embedded. Several licenses are embedded together, which wasn't the case several years ago. Post-incorporation registration, because when you register your company, so the first is the incorporation, you can have other needs than only, for example, a service company. You will be a manufacturing, or you need to have a trading. So you will need some other licenses. So it's post-incorporation, you will make some additional registration, for example, the customs. And the next step, it's the bank account opening. So in total, is between 6 to 12 weeks, depending of which kind of activities you are doing, which kind of where you are setting up your company. Why where? Just for the story, but we had, I think, 10 or 12 years ago to set up a Wi-Fi in Wuhan in a certain district, and they were not used to have foreigners. So the things you have to explain to them, to validate, and we are doing in other cities, in other districts, and for them to accept to do it on the same way. So they recheck all the regulations, etc. So depending where, you can have, the time can be a little bit more long. So in terms of bank account opening, you have several accounts to open. It's not only you open a multi-currency account or one account for your company. You have first a capital account to be able to transfer your capital. So your capital is checked and validated in foreign currency. An RMB basic account will be the one you will use day to day. And one reality you need to understand, it's the process all around the world, but in China it's a case as in other country, but the compliance is more and more tight. So you need to follow some procedures, but also need some physical presence for some processes. So not only the staff you will use to doing the procedure, but the legal representative as a notarized signature. Also, yes, you will receive the presentation for sure. That's why it's so detailed. Delays in account and strategic implication. Delays in account opening can happen because the bank or the branch of the bank, because each branch are working sometimes in a different way. Even if it's the same bank, they're not used to work with foreign entities, for example, and it can be longer. So you need to understand and choosing a bank and a branch have also some implication in terms of timing and processes. In terms of financial architecture, so coming back to what I mentioned before, we in China use the CAS, so the Chinese Accounting System, or PRC GAAP, so People Republic of China General Accounting Principle. So different kind of chart of account, also a different kind of mindset in term of accounting. So it can have an impact. So that's one of the challenge European company, but foreign company face when they come to China. Also, we have a golden tax system. So I can make a comparison with what's happening now in Europe with digital invoice, where some companies can be registered to take care of this digital invoice. Is quite similar, but we only have one system for that in China, not several providers. And it's important for FAPIA, so Chinese digital invoice, insurance, and also VAT filing. So it's also a tax system. It's a tax system and an invoice system at the same time. And also we have some needs. We are not always the same. We have needs in terms of a declaration to the authorities in terms of accounting every month. So every month per quarter, and annual by audit. So we have different timeline, but the monthly it's clearly an obligation for all the companies. So here I took two different kind of model we can face off. So the first one is the use of a local ERP. So let's say here it's you have to do your accounting internally or have someone to outsource it. But in terms of use of the software, you use a local ERP for doing it. So the pros of the local ERP, it's a full compliance with the local tax, the FAPIA, and some reporting requirement. One, it can be accounts. It's the manual consolidations of most of the statement, and mostly for the needs of foreign company investing in China. To have a global system, let's say a global ERP, so on the second model, it seems to be, so one of the pros is to have one place to have every information and to be streamlined with also the HQ, so the headquarters of the company. But so first, it can be a high implementation cost, and all these software are not really adapted for the Chinese CAS. And one is based on the regulatory changes we can face off, because it change quite quickly, and these software are not up to date with the regulation. So we move to the second step with much more. So during the first one it was let's say setting up or starting the company. So now we will be on a day-to-day activities. So in terms of treasury, foreign exchange, FAPIA, how to treat it, and group integration. So first, so let's say a word for the CFOs. One is dividend repatriation. So when you want to repatriate your dividend, you have a 10% withholding tax in China, who is requiring some documentation and processes. So just it's important to plan it in advance and not saying, okay, I want my dividends to coming back to the headquarters, so I'm doing right now and I will have it in a few weeks. No, will not happen. So a process should be made. One of the elements probably I need to explain is we have a SAFE, so State Administration of Foreign Exchange, will control the currency going out of the country and is a part of the process with the tax to check if you pay all the tax, so CIT, and also the 10% withholding tax before be able to transfer the amount of the dividend outside the country. In terms of intercompany loan, you can do it when you are purely in China, but if you are a foreign company and doing loans with Chinese company, even if you invest in it, even if it's 100%, is not, let's say, a free move. You have to register your loan, you have to process it before to be able to transfer your cash. So same, it's important to plan in advance if your company need loans. That's why at the first step, I explained that for the capital, you need to plan your capital for at least these 24 months to avoiding to have this different back and forth in terms of transfer of cash and to be blocked, for example, for intercompany loans. So when you are doing it, pay attention to have so to plan and to, let's say, make your loans or payment for a certain amount of time to avoiding repeatedly doing it. We faced off some clients doing an intercompany loan every 3 months because it was not well planned, and the cost would generate by all this loan and registration, it's a high burden for the company. In terms of working capital, so here we have we just one point about VAT refund, because you can be in terms of manufacturing, of trading, you can probably coming under the VAT refund scheme. So in terms of manufacturing is a process-based refund. So it can be different refunds depend of your process of manufacturing, depend of which kind of product you use, if it's semi-finished products or if it's a raw material. So it's a different process. And the trading is based on the supplier base, so based on the product they buy and they export. Okay, so that's why a lot of companies, when they do manufacturing, to avoid to be on a process-based refunds, they have also a trading company who do the job for them to let's say process the export to avoid the burden of the process-based refund. In terms of FAPIA management, so Chinese digital invoice, we have special VAT invoice with the only instrument who help you to decrease your VAT. So let's say to balance your VAT, if not, you will losing this cash. It will be you have different kind of FAPIA, so digital Chinese invoice. Some can be deductible, some other not. So it's very important in your FAPIA management to know which one you can decrease and those you will not be able to decrease. In terms of reconciliation, same. We face clients who want to use their invoice. So let's say standard previous European invoice to enter the Chinese accounting, but in terms of AP, so in account payable, it's very important to check that it's compliant FAPIA, so Chinese digital invoice, to be able to decrease to incorporate the expenses. So management of in FAPIA, so Chinese digital invoice, it's not a must, it's quite an obligation. And I just had some point in terms of insight is because in most of the European country, even the accountant don't speak so much with the tax or unless they have a big issue. For us, it's very different. We're speaking with tax officer regularly. So mostly for every client, we have to discuss with them 2-3 times a month. It's quite standard. So the thing is, it's a silent partner of your company and the management of your company at some point. So group integration and regulatory uncertainty. So here, transfer pricing, it's more and more checked, but the thing is not always checked as we can thinking it outside China, but it's the authority will see that you put the company you are, for example, you use your company as a distributor in China and you make it at loss all the time, they will understand that it will not be possible. So it's put some red flag, and it can be a risk for your company to be under tax scrutiny at some point. So pay attention to transfer pricing. Is not so, let's say, tight for now. It's tighter and tighter. But the thing is, some warning can be very can give to the authorities some vision of what you are doing with not compliant anyway. So you need to pay attention to make some profit in China to be able to continue your activity without putting your business at risk. Royalties and service fees, so it can be, for example, management fees. Contract should be clear, and you should have an operational substance. we see a lot of companies who don't have this substance, and it can be at some point also a risk, and keep all the information and all the documentation in case of tax control. So one of myths, let's say myth probably is not the right term, but the current account is something very widely used all around the world between headquarter or with branches or some sister companies. The issue here, it's we have, you probably know about the digital firewall, but we have a kind also a monetary firewall. So when this cash is entering as a current account, it can be as a current account in your company in Europe. It will not be treated as a current account in China, but as a revenue. So the thing is, these cross-border transactions as current account can be a risk. I can give you an example. It was 10 years ago, a client came at us because he had 2 million euro of current accounts with this company in China. So 10 years ago, 15 years ago, it was less checked. But at some point when he had to declare it and put all his financial statement clean, it was a big issue because you have to declare it at some point. These 2 million became a revenue. So the thing is, pay attention of the simplicity of the current account in your process of financing and group structure with your entity in China. And I just pinpoint a little bit more on this. Maintain all the documentation clear and clean. So how to navigate also the uncertainties to you have, depend where you set up the company, you have some special zone where you can have some tax exemptions, you can have some help from some district. So you need to really be aware all the time of what the policy, the new policy is where your company is registered. This reason is because you can have some shift. I will probably go deeper on it after, but the thing it's you can have change for several reasons. The district or the zone have to change their policy, and you will be blocked by this. So you need to follow this part, these changes. Not saying, okay, we register there, nothing will happen later. It's a big risk to take, and also audits. We have some. We didn't face off too much, but we saw some clients coming with not doing their audits, and this is for sure it's a big risk. And all the qualification of changes. So we have every year audit to do in China for foreign invested enterprise. So for that, for you, all should be well organized, because if not, the auditor will notify and he don't have all the information or things missing. It's always a warning for the tax or the authority or other authorities to make a check. Prepare a clear narrative for all transactions. And if you can have some people to advise you when you're not sure what you are doing, it can be something good, because you have the audit every year, but you can have also inspection from the tax. You have different kind of inspection you can face off. It's one from the Financial Bureau, with mostly the Bureau put in place the regulations in terms of CAS, of Chinese accounting standard, and after the tax. Okay, so the financial one is not a big risk in terms of penalties, but they can put some warning. We'll move to the next step, who will be a tax inspection. So one approach to have is to make a regular compliance review to avoid, let's say, to limit it to limit your risk. So in terms of exit, so when I said exit is not always selling, it's also leaving the country for several reasons. So you can have an exit planning. You can face some risk. We will see some scenarios, and also which kind of the board can face off. So I don't see. So exit planning, some scenarios, and put the context. It will be selling or closing your Chinese entity. So for that, let's say much more for the closing, it will be 6 to 18 months to close a company. Okay, it's not a last minute decision and say, okay, I send my documents, I close everything, it will be okay. No, it will not. It's a clear process to do. So the first line will be our process of closing. So the first one will be the tax clearance. So the first thing before closing a company is to validate with the tax and they accept the closing. And for that, they will check all the tax. They will even they can even ask audit for 3-5 years to recheck all the history of the company before validating that the company can be closed. So the tax clearance is the first step in any, let's say, clean closing. After that, if during the tax clearance it was validate, let's say at the same time, because if you do it clean, you have to, let's say, prepare the liquidation, need to settle all the debt. So with employees, suppliers, so tax authorities, but the tax clearance will be part of that. If you didn't clean all the tax you have to pay with the authorities, they will block the closing of the company and all intercompany obligations. So this, it can be a, let's say, a pain point when you have a lot of movement with company with the HQ, or you link to another company outside China, so a foreign company. In this case, I count Hong Kong as a foreign system, because one country, two systems, the system is different. So if it's a Hong Kong company who let's say, settle a Chinese company and you have in company obligations, it should be cleaned before closing. So it can be dividend payment. If you have no cash, you have any way to make every documents to prove that the other part will not ask for the dividend payment, not ask for or reimbursement of loans. So you have different kind of movement you can have with your mother company or foreign company. You need to clean. And after this second step, we can start to canceling all the licenses. Okay. So we have different government bureau to go and to in proper sequence. Is not random. It should be a step by step in a certain sequence to be able to deregister the company. So here we are totally in let's say standard way of leaving China. We will see two other scenarios below. So one is a solvent exit. So for example, selling your company in terms of merger and acquisition or strategic restructuring. So in this case, the best is not always the case, but it should be the best scenario is to have a clean asset transfer. So to avoid and to minimize all the withholding tax and on capital gain, have everything clean is always let's say the best advice I can give. And previously, as I said, for you accounting, you need to keep everything clean and tight. It's also for this reason when you decide to leave the country or to sell your entity. The time predictability is higher for sure, because you will have you always have some compliance point to cover, because most of the time the company didn't follow all the regulation changed, and they need to let's say uh, make it back to compliancy before to be able to sell. And a buyer due diligence will for sure scrutinize all the historical positions. So we see, for example, in the employee side, some lack of declarations of social welfare, because some clients don't pay attention of the level of the welfare, which is changing twice a year in China. You have different elements who will be for sure a point of scrutiny for due diligence at the buying time. A second point, a second scenario, it will be the distress exit, so bankruptcy or insolvency. So the legal representative may face travel bans if tax aren't paid. So a bad example we had several years ago, it wasn't a client, but I know well the one who had to face the issue. The two owners, so the one was a legal representative and the other one had a CEO position in the company. They left and let the one who was the highest position in the company to be in let's say in position to treat with authorities for closing the company. So the thing is, they had a lot of debt. They knew it. They left, and the rules in China, it's the regulation in China is to take, as it's difficult to discuss with people who already left China. They take the highest rank in the company still living in China. So I have several examples of that, and the people who let's say took 2 years of their life to follow trials, follow issues, because the company wasn't clean in terms of accounting and in terms of debt, finance and debt. So the first claim will be always employee wages and taxes. So if you have suppliers, etc., it will not be the first one to be taken in consideration. It will be always employees and wages. But one point you need to keep in mind is so things can happen. Company went bad, but the thing is, if you want to come back, the risk of reputation is very high. So if you're in distress, the main things to do is to close it cleanly, in a clean way. Because if you don't, it will stay in. It will be kept as a record. So the thing is, when you're coming, even after 10 years, I saw some cases. It can be coming back and said, okay, you didn't clean it at this time. So it's not always the company, but it can be the one who was in charge. So was a legal representative and didn't clean what he had to clean. So when he come back, he's blocked or have to take care of what happens before. So to protect the company in all way, you need to prepare a proper exit. It should be plain. It's not something you're doing just because you say, okay, business is not going well, I will leave. No, it's not really possible if you want to come back. So, so here in terms of good governance, we have some, let's say, I would say some pillar to follow to keep your house stable. So capital discipline. So in terms of your first capital injection, regular capital adequacy review to see if you need to reinject capital or not, and a plan if you have to increase. So not only capital, but if you have need in cash, plan it, prepare it. In terms of operational integrity, so you prepare some operational principle and FAPIA management as, let's say, the base of your system. And don't take it just as administrative task you have to do. I do business, I don't take care of my invoices or of the accounting or the finance. It's something so at the end will impact your activity. So it's not only some things you have to do, but some things in some way it's a backbone of your activities. So documented your process, try to have a track system for your FAPIA. So as I explained, for the Chinese digital invoice, you have some are deductible, some are not. So you need to follow and track them to be sure that your VAT deductions are accurate. And regular internal control assessment is not a must, is something can help you to stay on track. For the last one, if you have to exit, because these things can happen, so but it's prepared from the beginning, so to be clean all the time, to be able exit is not always leaving, but is also selling your company. Maintain clean books. As you are selling, you will sell next year with very, let's say, I think it can be a good motto for that, to keep everything in order. Audit ready financial statements, complete documentation archive, and regular compliance health check. So as I said before, it's not all the financial compliance. It's not an administrative task as in another. We company often think about finance like this, but the thing, or regulatory, finance and regulatory, but the thing is it's a competitive advantage at some point in China, because if it's not clean, it can be a risk for your efficiency and your development.